The correlation started rising in July of last year and it's currently at plus 0.45. This is a high positive correlation and far from what the market has seen in the last 20 years, but it's not unusual as the chart shows. Although high positive correlation is not unusual as some analysts may think, it poses risks to passive stocks/bonds allocations and especially to long-only risk parity in case stocks enter a bear market and yields rise. On the other hand, a high correlation is highly desirable when both stocks and bonds are uptrending. Both extreme scenarios described above have low probability, but a falling stocks and bonds environment poses significant risks to passive investors and further diversification may be a prudent decision at this point. No one knows what will happen because the financial system is highly complex and unpredictable, especially in the medium term. However, I suspect gold and commodities aren't a good hedge at this point, but this is my opinion now and can change depending on new information. In the above-mentioned scenario of falling stock and bond prices, in my max serious opinion, holding US dollar cash or going long the US dollar index, DXY, is the best solution, as long as the US economy is doing well or better than the rest of the world. Gold becomes a better alternative to US dollar cash in the case the US economy is struggling, i.e. US household debt as a percentage of GDP is high and rising like it was the case during the first decade of the 21st century, which then resulted in the great financial crisis of 2008. The gold-to-oil ratio is a good indicator when to invest in gold. For details see my video titled Oil to Gold and to S&P 500 Ratios Reach Record Highs in 2020, Is it a Bubble in Gold and Tech Stocks?